Howdy, Team 42. It's your skipper here, Darius to present another exciting episode of Pro to Pro Live. I'm joined by our friend Hugh Hendry, the asset capitalist, a man who needs no introduction. Man, how you doing today, Hugh?
I think the word is I'm feeling impeccable. I am feeling impeccable. It is an absolutely gorgeous, beautiful day in St. Barts, and I'm happy to be alive.
Oh, me too, man. I appreciate that energy, brother. I can see your view from the reflection of that painting, and I'm telling you, whatever you did to get there, it worked. It worked. Yeah.
Yeah, why? But I got to tell you, we're going to talk about investments and what have you.
Talk about
This is
it all. Let's
probably
go.
the best investment of my life. The and I I come to St. Barts as a caricature. I was a global macro hedge fund manager.
Yep.
I was operating out of London. Um, I would vacation in the Caribbean at Christmas time. My kids went to a very expensive school, and the more you pay for school fees, the more vacation they get.
Oh yeah.
And so we would go to the Caribbean and we would go to British Caribbean, Antigua, Barbados, and and here's my life's full of paradox. Here I am, right in the middle of the Caribbean, and I hate this damn place. I hate the Caribbean. I am a St. Bart's absolutist because it ain't the Caribbean. This place is safe, it's beautiful. All these other places, I found myself staying in compounds, security, etc. And then I'm a Francophile. I mean, the French, just the way the life, the joie de vie. And and so, but my contemporaries would come here, and believe me, I would certainly drink some rosé, but my mind never closes down. And so I was very curious about these beautiful houses, how much they cost, what you rent them for. And I thought to myself, I'm going to take one of these. I get paid in dollars. My cost base is in euros. So
Wow.
I was thinking of it as an FX trade. And then I was thinking of it as Bitcoin because you get there's a very limited land stock. I mean, this place is tiny. And then you get a halving concept, which is the draconian building and building code, which is making it harder and harder to build. So what I finished completing in 2015, you cannot build now. It's impossible. And
Wow.
and sure enough, this was the land was 3 million. I remember it had sat on the market for a few years. Abramovich had come in 2008 and he hadn't put St. Bart's on the map, but he paid $80 million for a beachside residence in
Wow.
February 2008, and then of course the banking catastrophe, and so prices plateaued, which is what happens here. They plateau at high levels, and then it's a step function higher,
Oh
and
yeah.
so my property sat on the market for 5 years, and I took it out at the previous buyer's cost level, but they were like, "Yeah, it gets too much sunshine." I was like, "Oh, really? Really?
It's
Maybe
like
you
a
could give me a
portfolio that goes
discount."
up too much.
Yeah, could I get a discount? So I got a little discount, and so that was 3 million, five to build, and the rest is history. It's like the Great Gatsby. But I mean, I'm not gloating. I'm just saying it was a
No.
fantastic leveraged investment, of course, with the banking sector.
Look, man, I applaud you for having the vision, and it's obviously where it's infused into your personality. I was saying in the pre-production that one of the things I most admire about you is you don't give a blank. Your ability to have non-consensus views that ultimately get proven right is one of a kind, man, and it's served you, obviously served you very well in your career. And so one of the things I
Yeah,
wanted to do today is kind of pick your brain on what do you think that the markets or the general discourse around markets right now, what do you think is missing based on kind of your research?
absolutely. So, and thank you for that. I mean, I am. What am I apart from quaffing rosé? I am I we need a purpose in life, and I don't know if this is my purpose. I mean, I believe the tenets of a good speculator are encapsulated in three very very similar words: playfulness, curiosity, and mischief. You got to be mischievous. Um, and and I have this acid capitalist brand. I am the acid capitalist. You'll find me on Twitter and all these places, Patreon. I've got it written on my chest. I've got a tattoo. I'm the acid capitalist. And
First
there's a
chest sighting on our program, by the way.
yeah, boom, baby.
Close to the acid cap.
Close-ups available. But if I have a mission, it's to kind of try and correct, um, like finance quite rightly gets a bad rap. I mean, it just feels toxic. I mean, it just doesn't feel sexy. I mean, I know we get Wall Street and we get the Wolf of Wall Street, but they're almost parodies because the general public are like, oh, I don't know, I don't know,
Oh yeah.
and I feel that's an error because um, when it's um, in its purest form, it's an art form.
Oh yeah.
And when I look back on my career, I liken it very much to the journey of an artist. That we start with this blank canvas, and you've asked me to take the blank canvas today,
Oh
right?
yeah.
Um, and my mission was always to attempt to conceive of a contentious posture, which I thought could go that had the capability of fermenting in the minds of many, many people and becoming the accepted belief system.
Mm.
Okay. And so that was my tapestry. And of course, I'd be seeking the sponsorship of wealthy family offices back at the beginning, and then it became institutions who wanted to sponsor this vision
Oh
and
yeah.
hopefully participate in the because when you go from like crank to the accepted belief system, yeah, you make a lot of money. Um,
Oh
and
yeah.
and so that my crankiness, I can remember, prior to 2008, my mantra was from 2005, 6, if you think the future is inflationary, you gotta buy the long bond. And at first, second, and third blush, you're like, that's crazy.
Yeah.
Um, but it's all about throwing kind of logic hand grenades and then trying to rebuild grabbing their attention and then trying to rebuild the logic of what you're saying. And
Mhm.
back then, I was saying that if you wanted to see gold at $3,000, you know, which is where it is now, I was prophesying that you really needed a profound deflationary crisis,
Oh yeah.
which would bring the Fed to the interest rates that we see in Japan. Well, tick, 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 and all of that happened. So let's become contemporary and get right up to date. Um,
I would say beyond contemporary, it's now part of the way in which everyone approaches financial markets. I would say when I started my career and I started back in 2009, the Fed was a big player, but it wasn't, there was a real healthy skepticism of what QE was and what it could do for markets. I would say up until about 2015, 14, 15. At first, maybe 4, 5, 6 years, there was a lot of kicking and screaming and angst about the inflationary impact of QE and how it ultimately caused more problems than good. And I think societally wise, we certainly do see a lot of political issues as a function of that. But from a market standpoint, your belief system really has become the belief system as it relates to the Fed's role in markets. So congrats on that.
uh, yeah, I mean the quantitative easing, I think, is just nonsense. I mean the Fed um, really has very little to do with it. And it's jumping up and down saying, it's me, it's me, it's me. It's the Wizard of Oz that
Oh
the
yeah.
Fed is the wizard. And when you actually go behind the curtain and you look at the toolkit, they got nothing. All they have is the pretense that they are omnipotent.
Oh yeah.
And so uh, it was this shock and awe thing. Because remember when they announced it in March 2009, we
Yeah.
went on a tear in
Oh yeah.
terms of the US dollar was going to become the Zimbabwe dollar and hyperinflation. We had a profoundly damaging bull market in commodities. I say damaging because the price mechanism in elevating the price of all the basic commodities, it encouraged the chief executives of all the mining groups to spend billions
Oh
at
yeah.
the wrong time. And all of those executives responsible for those decisions, they got fired. I mean, those stocks have been dreadful. Now,
Yes, sir.
why um, the QE thing and its impotence? Why is it impotent? It's impotent because um, you essentially it's a transfer of an asset on the bank's balance sheet from being a treasury to being a reserve with the Federal Reserve, yeah, central bank reserve. Um,
Yep.
but it's very high powered money. With that reserve, you can create a lot of money, a
Oh yeah.
lot of money. The problem you have is that no one's willing to do it. Everyone's like, oh, yeah, I did that in '06. I did that in '07, and I came to regret it. And thank you very much for the alcohol, but the party's cancelled, right?
Oh yeah.
And so again, to bring this to relevance today, I've long argued that so there's a temptation. There's like so the central banks of the world have given this alcohol to the private banking sector, and for ever since 2008, the banking sector's like, no, 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 hungover, I'm hungover. Now,
Yeah.
the society that went first into QE was Japan,
Oh yeah. Of
and they've had 27 iterations of it, which demonstrates that it doesn't work.
course.
Again, it doesn't work owing to animal spirits, but it would work when they eventually go, you know what, I'm doing it. And I think the Japanese did it. I think they took these inert banking reserves, these JGB overnight cash notes, and they went into the Eurodollar, the swaps window, and they went to their international peer group and they said, what would you give me? I've got $1 trillion of this stupid money thing, right? How many dollars would you give me in return? Like if I pledged this, how many dollars would you give? And dollars are you can have fun
Vindication
with
of the
dollars.
financial system.
Exactly. And I think to their surprise, their international peers said, no haircut, 1 for 1. And they're like, well, really? Really? And so I think they did that. And I think the money center banks in Japan via the Eurodollar system essentially underwrote all the astonishing bull markets. We live in an environment which is the overvaluation of everything.
Oh yeah.
Um, and an indicator of my hypothesis, and it's nothing more than a hypothesis, is that dollar yen um, dollar yen troughed or peaked. The yen peaked in the week, and I think it was in 2021 when we first heard of the scale of the bankruptcy that was looming in the Chinese property sector.
Yeah.
The giant property company that had, I can't remember its name now, the $300 billion of
Evergrande.
Evergrande, thank you, of debt. Back then, dollar yen was, let's say, 115, and we went 115 to like 162. Now, what's the association there? The association would be in that Eurodollar system where you're pledging collateral and you're getting dollars. It's a 24-hour cycle, so you got to keep going back saying, "Are we cool?" I mean, it's a pawn shop. You got to go back to the pawnbroker every day and go, "Are we cool?" He's like, "Yeah,
Oh.
we're cool, we're cool." But then the Evergrande news, and the pawnbroker is like, I don't know if we're cool. I don't know if we're cool, right? And I
I
mean,
love
not
the sticker.
immediately. Yeah, he's got a wife beater vest on. He's got shades like this. He's like,
Gold chain.
I'm a little bit worried that you guys have been naughty and you've been taking my dollars and you've been lending to the Chinese in that damn property market. Tell me it's not true. And the Japanese guys like, oh, and then these smoke like 100 cigarettes like all at once. No, 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 you misunderstand. And it's like liar, liar, pants on fire. So we went from a situation where JGBs were money equivalent. Like money in our modern universe is cash treasury, cash dollar treasury, dollar bill, baby. Yeah.
Wait. Oh yeah.
And we had an environment where JGBs were 1 for 1. So they were money because they resembled and they had an equivalency to dollar treasury bills. But now, as some of these bull markets start to flare and go over, as we've seen in China, There's suspicions about what the Japanese banking community have done with their credit allocation. And so they're getting haircuts. Now, when you get a haircut, it's like, listen, you can keep the position, but rather than just give me your pledged JGBs, you got to start giving me some dollars as well. So at the margin, you're selling yen, you're buying dollar. And I think that's the mechanism that took us to 160. And I am still willing to be contentious and say, I don't think this is over. And I think we could see 200. I think we could see a profound unraveling of the yen. And I say that because um, they're playing poker like with the likes of me. All right. And you don't want to play poker with me. I'm a badass.
Can't
Because
even
they're
see
like,
your eyeballs.
yeah, oh, dude, they're like, yeah, we want dollar yen has been very weak. And it has been. I mean, let's just say, with all seriousness,
Yeah,
you
it's
had a 30% devaluation in the yen versus the dollar. Now, you bring up 100 years of data. That is an almighty in terms of major FX crosses. Yeah, don't move 30% in like the space of 12 months. That is profound. And therefore, it signifies something of unease, something's not quite right below the surface.
of
Okay.
course.
So they have to respond to that. And of course, they did the FX intervention. They've got a glorious balance sheet. They own a lot of dollars. And so they sell some, they buy yen. This doesn't seem to work. And so the last bastion is, hey, we're going to raise rates. And it's like, shut up. You're not going
Don't
to
do that.
raise rates. Because
No,
if
they're
you,
gonna try. They'll
yeah,
try.
yeah.
Yeah.
Well, I was like, okay, well, let's watch that, because so you raise your short rate, but what we kind of know what happens is you get flatness in the yield curve initially, and then you get an inversion because
100%.
um, the and they're like, oh, we're going to go to 2% or so. If I if I lost you there, no, I'm just
No.
you're thinking things up. That's cool, right? Yeah.
Yeah.
Um, the um, So what the big drama with the US has been the $1 trillion spent on servicing the US Treasury, the debt, the deficit, yeah,
Oh, yeah.
and how the Treasury debt servicing is greater than defense spending, right?
Oh,
And
yeah.
that was with the US going to 4 or 5% interest rates. Okay. And Japan, the thinking is they can go to two. And if they go to two, they'll be challenged to go to 2.5, three, 3.5. But US debt to GDP is 50% of the level prevailing in Japan, which is to say they cannot raise interest rates. They
Oh, yeah.
cannot raise interest rates. So I'm watching that. And all of the I always think there's a trap in logicality. I try not. I'm always nervous when my positions benefit most from logical things happening because that's a
Mm,
crowded trade. That,
yeah.
and that's what you find. Like we've had an 8 to 10% correction in the S&P. What's gold done? Ain't done it. Like because too logical the notion that gold's going to protect you if the S&P falls. Yeah, ain't gonna happen. So I'm always vibing with the not irrational, but there's a logicality leap that you've got to take.
Oh, yeah.
Um, and that's where big opportunities sometimes rest. So I'm still a dollar bull, and I think there's still going to be unraveling coming out of the Japanese banking sector. But um, we'll see. We'll see.
I like it. I like it. A lot of stuff there, man. So one, thank you for explaining a lot of that stuff. I did want to pull on a thread before we sort of get into the actual theses that you currently have. For
Yep.
those who may be, most people are not those maybe, most people are less aware and less familiar with the Eurodollar system. Can you
Yep.
give us like a 2 minute, 3 minute summary of exactly what's happening there? You alluded to the Fed being the Wizard
Yep.
of Oz, not being omnipotent. Clearly, you think the Eurodollar system is omnipotent. So, what is it? How does it impact markets? How do you game it as an investor?
Well, thank you for that opportunity. So the the Fed was king and king at the poker table up until the era of Volcker, and I think ever since, and I think actually Greenspan actually admitted most of this, and they were king because they were um, the the regulator of the domestic banking sector in America. And up until the 1970s, the majority of money creation was M2.
Yeah.
And what is M2? M2 is the measurement of all bank deposits in America. And a
Yeah.
deposit for a bank is a liability. They have to pay you interest. They haven't paid you much, paid you more in the last 3 years, but they haven't paid you much in the last 15 years. But they have to match assets with liabilities. And so they'll extend credit, mortgage loans, commercial and industrial loans, and their book will balance.
Yeah.
Um, and that is subject to Federal Reserve regulation with regard to leverage and prudence and the like.
Yep.
And that system was supplanted by a matrix like mysterious offshore digital system where all the banks are connected. And it's regulated not by bureaucracy, it's regulated by your reputation. Like
Mhm.
the people who know where the problems are your peers, right?
Oh yeah.
The people who find out last are the regulator.
Oh, always.
And so it's a system where you borrow and lend within your community in an unregulated manner. And the leverage which is afforded to you is gargantuan, multiple times greater than what the stodgy Federal Reserve would do, which is to say that the profit opportunities from that lending matrix are far greater.
Oh
And
yeah.
therefore, no surprise that it's supplanted. So the money creation, so credit creation, is predominantly from the Eurodollar system today. It towers over the amount which is the amount of credit which is coming from just your bank
Oh yeah.
saying, "Hey, I'm going to give you a mortgage." And again, I liken the Eurodollar system to a pawnbroker that you've got a bank which has got excess, it's got an excess balance sheet and it's looking to put it out
Yeah.
and make money, but it's it has to take care, it has to do risk assessment, and so it wants you to post collateral, and the closer you can post something which looks and feels like a US Treasury, then they won't give you a haircut. But if I
Mhm.
was to post if I was to post like 10-year Indian sovereign debt, they'd be like, "Oh, that's not a US Treasury." So, if you post $1 billion equivalent of an Indian, treasury, I'm going to give you maybe three, four. I'm making these numbers up. I'll give you $400 million. Yeah,
Mhm.
so a huge haircut. Okay, but what I was saying is that in the deep pools of Japan and Europe, it's 1-to-1. So in Europe, it's a bit surprising, but the principal collateral. So this is an asset that banks seek to own because they can transform it into a money-making asset. Um, but in Europe, you would think it would be the German bond, the Bund,
Mhm.
but it's not because there's not enough boons. I know that our German friends have only just pivoted and they've said, look, we promise we've been really, really not dull, but we've been very, very conservative. We've had this break on fiscal spending and
Right.
our government debt to GDP, I think it's like 60%, way
60%. Yeah.
below their peer group. And they're like, but we're going to change it. But they haven't been issuing a lot of debt. And the debt that they issued was swallowed up by not the Federal Reserve, the European Central Bank in their QE policies were buying the best, safest debt, bizarrely. Um, and so when you're in this Eurodollar system, it's risk assessment. And one of the major risk factors would be liquidity.
Oh yeah.
So the most liquid European government bond market is the Italian BTP, the 10-year Italian. So all the banks clamor to own the Italian because with that, you can present Italian bonds into the Eurodollar system and you will be presented with dollars with no haircut. So it's just you're pledging something and you're getting credit, and then with that credit, you might lend to a hedge fund.
Oh yeah.
You might have lent to a Chinese property company for speculation there. You might have lent was speculation on the movement in the mix, the Mexican carry trade versus the US dollar. You could have been financing Mag 7 investments in the stock market, you name it. But the
Are
curse
those
is,
investments off balance sheet then?
um, yeah, um, the it's almost like the Fed's like, oh man, I'm so weary. Like I find M2 and CDs is exhausting enough. And like, you really want me to go into the matrix and compile all that? I'm like, I'm too tired. And like, and anyway, no one cares. They all think I'm the wizard. It's
Yeah.
almost like that. They should have the data, and they just like, nah. I'm like, my franchise stops here. I'm busy. I'm not interested. But it's
Wow.
enormous. Now, the last thing I want to say is that the credit that is, so again, forgive me, but I've got
Oh, this is amazing. Keep going.
an Italian bond, and I post it, and I don't know, a bank in Japan, but it won't be Japan, like a US bank says, "Oh, I've got surplus dollars. I'll take your collateral. You take my dollars," and then with the dollars, they then lend those dollars to a hedge fund, and then the hedge fund goes to their prime broker, and then leverage. But you're not it's not credit new borrowings designed for physical purchases, like a new factory, an expansion of physical capital goods. It's all speculative.
Mhm.
So the predominance of credit flow for the last 15 years has gone into financial assets. And again, back to what I was saying, we live in this era of the overvaluation of everything because we have this spigot, which is this Eurodollar system, and it's been creating this enormous, unregulated, enormously leveraged pool of liquidity.
Oh yeah.
It's inflated assets. And what I think is happening now is the repercussions, like markets are blowing up. Eventually, there's a tipping point. There was a tipping point in Chinese property eventually. There was a tipping point in 2006, 2007, with US real estate, and it tipped and it went over. And there's a tipping point, it would seem, in Chinese equities, the Indian stock market, the Brazilian stock market. They're like, oh my God, everywhere you look, there's a tipping point. Things are kind of tipping down. And at
Yeah.
that point, it starts revealing these hidden matrix-like credit systems. So I think you'll be hearing a lot more of it. But dollar yen, where we started this, and you were talking about the euro dollar system, that's just this old, you know, probably the biggest pocket of liquidity in the Eurodollar system is Japan, is Tokyo.
Yeah.
It's
Yeah.
just so forget about the name. Just think of it as like the matrix, the
The matrix.
pawnbroking matrix, which
So
has
what
inflated everything.
well, that's probably the best explanation of the pawnbroking matrix that I've gotten in my career. So hopefully everyone's really appreciating that. I certainly am.
You mean
What's
it's
your
the only explanation you've ever received? But
No,
anyway, but
I've heard people talk about the Eurodollar system, certainly different aspects of it, but no one's ever connected all four corners of it, all four walls of it together in the way that you did. So I just want to say thank you for that.
thank
That's
you.
amazing. Where are we in the pawnbroking cycle right now? Like what's your sort of highest conviction view as it relates to should we be risk on in this cycle or should we risk off in this cycle? And what are the catalysts that you're looking for?
I mean, I'm beginning to think. Beginning, I've been rehearsing this argument for maybe 5 years or so. That the site this I'm looking, so there are many cycles, in
Oh yeah.
oscillations, and I'm looking at a very long-term oscillation, maybe 100 years,
Wow.
and 100-year oscillation would take us back to the 1920s.
Oh yeah.
And at the end of the 1920s, we saw the death of money. We saw a monetary system which died, the the gold standard.
Yeah.
Um, and I would actually say it was reinvented into Bretton Woods.
Yep.
Bretton Woods gets all that the headlines, but Bretton Woods was supplanted starting in the 1960s and then really taking off in the 70s by this damn Eurodollar system. So I'm glad we spent a lot of time on Eurodollar because, to my mind, Eurodollar is the mechanism of accentuating of money. So in the 1920s, high-powered money was gold.
Yeah.
If you, as a sovereign nation, if you secured more gold, and you'd secure more gold by running trade surpluses with competing nations.
Oh, yeah.
Then this high-powered money, gold, would be transferred to your banking system, and that would be a again, it would be a liability to this. It'd be a liability to the system, and with the gold, they would then go to they would be encouraged to make credit and to loan, and so the person in the 1920s who ran trade surpluses was the person who got credit expansion in their domestic economy, was the
Oh, yeah.
person who got amazing productivity gains, who got 3-4% GDP growth,
Oh,
when
yeah.
the rest of the world had travails. So America was the China of the 1920s,
Oh, yeah.
and Europe was in a deflationary funk.
Europe
Uh,
was the Europe of 1920s.
yeah.
No offense.
You're just you're just Europe.
Yeah.
So um, this time around, uh, and we've labeled it, but you want dollar treasury bills. That's your high-powered money.
Oh, yeah.
If you don't have that, you want the closest substitutes to it, which have been JGBs and these Italian bonds.
Yeah.
Okay, and then and with that, you've gone and you've bought lots of assets, and so we alight on the 1920s where asset values got very high, and then people questioned the sanctity of the monetary system, and the monetary system broke. And here we are, and assets are very, very high. And I think people are questioning again the sanctity of the monetary system, and it might break as people become forced sellers. And the thing that's being questioned, I think, is the money likeness of the JGBs, the money likeness of everything else except dollars that you're getting. I mean, this is a bit of a reach to say just now, because the dollar index, as you know, for the last month or year to date, it's been weak, and it's been weaker than I would have foretold. And again, I say there's a bit of a logicality trap. Everyone logically thought it was going to be strong, and therefore it's going to chase you out. I think we're still within the realms of a correction, but
Yeah.
I think we're going to see further dollar exceptionalism, where it's like, if I don't have, like, I thought I could live with having JGBs and European bonds. I can't, like my real the thing that will my real superpower is my ownership of dollar treasury bills. I've got to own them. Now, blah 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 blah. Let's start again. Let's talk about really, really where we are, because the big thing that we're confronting is Trump Gorbachev.
Oh, yeah.
Have you heard this debate?
No, I've not. Please
You
don't.
know, heard it. Are we seeing perestroika? I sound as if I've been drinking too much glasses of rosé. The openness, the openness that Gorbachev opened and introduced to the USSR,
Yeah.
and economic, modest economic deregulation and the like, and Gorbachev has, I think, gone down in history many things,
Obviously.
but he kind of inadvertently blew up the USSR. He's like, "Oops, did I do that? What happened to the USSR?" And they're like, "Dude, like, you blew it up." And he's like, "Oh, right. But with the best intentions." And so there's an argument that so we know that Trump's the man, and we know he likes to be a strong man.
Oh, yeah.
He wants to be a man of history.
Yes, he does.
And so he's looking around at strongmen. And so you can just imagine the conversation that's happened. And it's like, who was the strongest man in American economics? Like, who's up there in the pantheon of the last 40, 50 years? And I mentioned his name previously. I'm going to say it again. Paul Volcker.
Oh, yeah.
Paul Volcker had the audacity to increase interest rates in a US recession.
Audacity.
And not just a little bit. I'm talking a lot. And I mean, he smoked a cigar. So he wasn't a cigarette. He was a cigar guy. And back then, the Federal Reserve would announce interest rate policy shifts on a Saturday. market. Imagine that, like weekend, you know, you're down in
Anyway, to
Miami,
St.
you're like,
Barts, you know.
yeah, and it's like, oh my God, they've just raised, and not like 25 basis points,
Oh,
100,
2%.
basis points.
Yeah.
And you're like, we're in a recession, honey. What are you doing? And he's like, I'm the new sheriff, and we got a malaise in the American economy. You know, I'm here. There's good news and there's bad news. The bad news is my friends at the Federal Reserve, we've been lying to you. You know, when we told you there was no inflation, oh, liar, pants on fire. There's a hell of a lot of inflation. The good news is I'm the sheriff, and I'm tough, and I'm going to do something about it. And America in all its majesty will be preserved.
Yeah.
But the next 2 years, it's going to be a little bit tough. Okay. And
Totally.
he's a hero, right? So fast forward, here we are 40 odd years, 45 years later, and the Republic is in danger. Yeah. We have the euthanasia of this fiscal expansion. Yeah. The Treasury Secretary, his ultimate boss, Stan Druckenmiller, right? Stan's short the Treasury. He's like, Stan is speaking to Stan. If Stan was walking down Manhattan, Stan would go up to strangers and plead with them. He's like, look, you've got to understand the budget deficit is terrible. We've got to rein in the spending. And we're getting Druckonomics now. And I think someone said to Trump, you could be Volcker because we're going to get a recession. And imagine you're the president that actually is fiscally conservative. Imagine you're the president who balances the budget in a recession. I mean, they're going to carve your big damn pointy nose into a mountain. You know, you're going to be history. And I think he's taken it. You know, you've got Doge, you've got the tariffs, and Scott Besson. I mean, I'm loving Scott because all this overvaluation. We talked about the Eurodollar system, right?
Yep.
And we said at the center of the Eurodollar system was this pristine money, which was U.S. Treasuries. Now we can peel back even more, right? Because if you peel back further, and we're trying to find the true origins of where all this liquidity came from. You know,
Right.
people always talk about liquidity, and I swear to God, they're making it up. Seeing they say, oh, the market's going up because of liquidity. They make like the only liquidity. I'll tell you that liquidity is created by stock prices going up,
Yep.
and it's destroyed when stock prices go down. That's it. Okay.
Yep.
But the true source of the overvaluation of everything in terms of financial assets is China. In 1994, China devalued its exchange rate vis-a-vis the US dollar, coincided with the NAFTA, the North American Free Trade Agreement, with the dollar and the peso, and China devalued, and it's pretty much kept that level since 1994. Now, in 1994, the Chinese economy was the nominal size of today's Turkish economy. And today, the nominal size is equivalent of the European economy. So, which is to say, a lot of good things have happened. Like China's like been on a roll. It's got bigger.
Okay.
And the dollar renminbi is one of the most important market prices
Agreed.
in our universe. And
Agreed.
it's been wrong and it's been manipulated for 30 years.
It should be way higher. It should be much higher in price.
It should, like they've run persistent trade surpluses.
Yeah, totally.
And therefore the currency should have gone higher to arb that out, and not in a mean sense. That's the reward for success, because you make your citizens wealthier vis-a-vis us. You can buy a Boeing 747. You don't make 737, or you can buy a BMW. You can buy a Tiffany jewelry, cheaper because you did smart, clever economic things.
Yeah.
But that hasn't happened. And it hasn't happened because they took the $1 trillion of trade surpluses every year and they bought risk-free US treasuries. And so they said to the world, they said, give us more and more treasuries. And so they encouraged the creation of high-powered money. And with that high-powered money, we now have every financial asset overvalued. So there's a lot of things happening.
So you're saying the Chinese banks are taking that high-powered money and then lending it out in the matrix?
I'm saying to you that the S&P, you ready for this?
Yeah.
So and we talked about Volcker. So he finally rates peaked in 1982, and the stock market troughed. And in 1982, the S&P in real terms wasn't much higher than where the Dow had closed the 1920s. I mean, it was, like Volcker took the 10-year was a 16%. Now, so from a very low level to a very high, to today's very high level, how many times do you think the S&P has gone up? So I call that, like trading jargon, we call that a bagger. Like, has it gone? Is it a 10 bagger, a 5 bagger? How many bags? What kind of bagger is the S&P between the lows of 1982 and today?
I'd say 50.
Well done. You are damn good. 60. A lot of
60.
kids don't get it.
Yeah.
You know your stuff. But that's
And,
wow, it's a big number, right?
yeah.
And I'm saying to you, that's come from this, it's come from the rise of China, the manipulation of a very, very important exchange rate, its desire and demand to own and to sponsor US treasuries, the sponsorship of US treasuries, then being the money of the system, and then having a money system that then percolates and just goes into a speculation. That's where we are. And that's why I'm talking about the death of money. And
Yeah.
so Besant is saying, you know what? This arrangement where we have tolerated the lack of a market price for dollar renminbi, we have tolerated. Why have we tolerated that? We've tolerated that because it has inflated Wall Street.
Totally.
And who sponsors the election? The election is sponsored by rich folk on Wall Street, right?
Oh, yeah.
And they want the status quo. But you know what? At the same time, it's been terrible for the average American household has become impoverished. So you've got two ways. You've got the impoverishment of the Trump supporter, and you've got the great richness of Wall Street.
It's my
And
favorite
best,
chart.
there you go. There you go.
This is the labor versus capital chart. This is why they're trying to go from paradigm A to paradigm B. I
Yeah.
don't know how successful they're going to be or if they're even implementing the right policies, but Hugh, you just nailed it. The
Well,
entrenched interests represent this peak here in corporate profits, and the usurpers represent, hey, we want a piece of the economic gains too. And how do we get there? And how destructive is that process going to be?
yeah. So and that's my glasnost or my perestroika.
Yeah.
They come in, they said, we have a mandate from the people and we feel obliged. Okay. But when so remember, we've always known that China was gaming the system. We've always known that the renminbi is fixed, it has no vol, it's an artificial oddity.
Oh, yeah.
Which has made it's made the Chinese Communist Party rich. It's created an enormous GDP. It hasn't created huge wealth in China, but it's created huge asset price inflation in America, and no one in America dared tamper with it, because if you touch it, stocks collapse. And that chart is all about, to correct for that, stocks have an almighty bear market, an almighty bear market. Like, we have to deflate the valuation of all assets. You want to, in 20 years' time, you're going to go to dinner parties and you're not going to brag about the value of your property. And again, what did I do when we started? I was like, oh, I'm like my $30 million shack pile in St. Barts. I'm bragging. I don't mean to brag, but you know what I mean? That goes from the conversation. And you're talking about your industrial endeavor. We're trying to change. We're trying to get America back on track from being this amazing entrepreneurial society and take it away from the speculative nonsense of where we've been. But it has consequences. So the stock market will fall on this. The Fed is clueless, really, really, and clueless. So, and we have to discuss the clueless. Okay, I want to ask you a question. Why did the Fed cut rates on the 17th of September last year?
Cut rates.
And they cut rates by 50 base, not even 25. They went 50, and then the next meeting they went another 25. The next meeting another 25, and then we went into January, and then they showed interest rating cutting remorse. What was going on there?
Well, I know what the conventional answer is, but because you're not a conventional guy and you've opened our eyes to a lot of the different dynamics, I'm guessing They wanted the dollar weaken against the Japanese yen
Why?
because there was a destruction of capital globally, and they realized that it would start to spiral.
Yeah. But what about, okay, so I don't think that.
No, yeah, that's my guess. I don't know the answer.
They,
I'm actually curious.
okay, and the answer is going to be, and the answer is going to be sponsored by my beautifully, I was going to say erratic. Erratic's not the word.
Maybe it is.
But the enigma, which is Mr.
Yeah.
David Levinson.
Oh yeah. I
Um,
got him on next month. I'm going to make sure he watches this and then
oh,
comment.
oh, if you think I talk a lot, I mean, David is he's number one. Anyway, so um, over the summer, so background last year,
Mhm.
sovereign bond yields in the rest of the world collapsing,
Oh yeah.
bond yields going down. Um, Chinese bond yield, 1.6 on the 10-year. And July, August of last year, the 10-year treasury is 3.6. Fed's at 5.5,
Right.
right? The market's like, you are clueless. We're 3.6, right? And the Fed's biggest nightmare is a parallel shift where the 10 and where it has to catch up with the 10, and then the 10, the curve just parallel shifts lower, 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 all the way down. That's what's happened in China. When that happens, you destroy the banking sector. There's no
Yeah.
profitability, and with no profits, there's no appetite for risk taking. With no risk taking, there's no economic growth.
Yeah.
Um, and so that was going on. And secondly, uh, the holy grail for a central bank is the what do you call it? The soft landing.
Oh yeah.
It's the holy grail. Benjamin Strong, the New York Fed governor, went for it in 27, and he blew the system.
Yeah.
Greenspan went for it in 1995,
Yep.
and it blew the system. And Jay went for it in that meeting, and I'll tell you why. Because Um, and this is very much David, and David will blow your brains out on this. I had missed this. Um, so I don't know if you remember, we had a pandemic. We had COVID,
Oh yeah.
and 10-year got to 47 basis points. At one point, the 30-year touched, I think, 87. I mean, touched and then but 87 basis points. Um, Obviously, Fed funds rates were zero, and there was an enormous amount of refinancing. I mean, unless you were mentally poorly, you were refinancing your mortgage, yeah.
Oh yeah.
And so today, the stock of the US mortgage market is unique to America. Like, we don't have the same system in Europe or elsewhere, pretty
Oh
much.
yeah.
Um, the size of US mortgages is $13 trillion. Okay. Now, to put that in context, that's 50% of US GDP.
Yeah.
And that is about 2.5 times greater than all 10-year plus US treasuries. Like,
Yeah.
there's a ton of US government debt, but it's bills. They've been issuing an
It's
enormous amount of bills. The duration stuff is 6. So the mortgage market is enormous. Um, and what we don't realize is there's an iceberg. So we don't see there's no refinancing activity, because the 30-year mortgage is fixed, is what,
7% now.
yeah, been bobbling 7, coming down a bit.
Yeah.
No one's refinancing there, right? But remember, we were at 3.6 in the summer of last year. And at 3.6, the notion of going to 2, it's not that absurd, especially when the Chinese rate is 1.6 and
Oh,
skidding to 1.4,
yeah.
and the German thing is there. And indeed, with those high rates, it's a magnet for every other bank in the world to come in and take and bid that yield down.
Yeah.
So what the Fed's saying is, the economy's good. The all last year, I mean, the economy's just suddenly diving off a cliff a bit, but that's in the last 4 weeks. Up until for the last 18 months, the economy has been wonderful.
2 years plus. Yeah. Booming.
Yeah, outperform. Now, it's had a lot of fiscal gas in it, but
Oh
it's
yeah.
been very, very good. Um, and so Jay was like, and he's got inflation coming down. He's got an economy which is kind of like 2%. But what he's actually seeing is like I think he was saying to him, I think he was saying to himself, what if the 10-year slips rapidly to 2? Let me tell you what happens. At 2, suddenly the iceberg under the surface is you suddenly make that entire $13 trillion of stock available to refi. And if you refi it, you're going to get enormous liquidity to the household sector. They're going to start moving house. They're going to go to Home Depot. They're going to take a second lien. They're going to spend. They've been held back. They're paradoxically been held back. So the economy's good, but if Jay let the curve and the 10-year come all the way down, paradoxically, and the paradox is where the many don't live, and
Oh yeah.
so the many don't get these insights and these profits because they don't live in the paradox. The paradox is the 10-year coming down to 2 and below 2, you get an you actually blow up the US economy, and you're back with like 5-6% inflation, and the Fed's like they're caught in the 70s trap with the Fed, where the Fed thought they'd done the job, and then there was that second wave. So Jay, perversely, I think, in cutting in September, in November, and December, was actually trying to stop the 10-year coming down. He wanted, and he created an inversion in the curve, right? He got the 10-year to 4.7.
Oh yeah.
And he got his rates down to 4.25. So he got a degree of inversion. Now that's flattening again. I think that moment has passed.
Quick question. This is fascinating. It's definitely the most unique take I've had on that, and it's probably means it's the most right take I've heard on this. Two questions, I guess. One, it doesn't strike me that anybody at the Federal Reserve is thoughtful enough about these sort of matrix pawn shop dynamics. So why do you or David believe that he had that sort of foresight? And secondarily, what is the it seems almost perverse or inverted that he would cut rates to prevent that outcome. Can you explain those two different things?
Yes. So on your second point,
Yeah.
the perversity. Forgive me, I should have said to you, they were pursuing a radical central bank policy recommended by Krugman to the Japanese to escape the zero bound.
Yeah.
When you can't, when you're at zero and negative rates don't seem to be having much. Krugman recommended to the Japanese that in order to shock the system, to change investor expectation, the central bank had to solemnly promise to act irresponsibly.
Ah.
Okay. So what I'm saying to you is Jay's objective was to raise the 10-year.
By refloating the economy.
And if we do subtitles, it'll probably say tenure, like professor tenure. I'm saying 10 year bond yield. Jay wanted the 10-year bond yield at 4.6 or closer to where he was starting at 5.25, 5.5 policy. And he's like, I want to be able to come down and go below the 10-year. That's too far away with the 10-year at 360. If I can get the 10-year to close on 5, then I can get inversion, I can get steepness, and now I'm taking action. I'm down at 4. And the inflation data, like today, another clip, inflation is under control. It's coming down. And he's like, my policy rates are too high. I cannot lower my policy rate without either arresting the decline in the treasury yield or pushing the treasury yield up. Now, again, this might be importing way too much too much intelligence to the guys running this. But actually, let's not be conceitful. They're smart people, and
No, I agree. I agree.
this stuff, right?
Yeah, no.
And so their objective going into that meeting was a steepness in the curve, which is to say they wanted their policy rates within 3 months to be below the 10-year, and they wanted the 10-year yield to be higher than the 360. And they achieved that. But to achieve that, they had to walk in and go, surprise, 50 basis points. And everyone was like, what? what are you,
Hugh,
like the economy is rolling. Why are you cutting rates? You guys are irresponsible. Thank you very much. Yes, we may be a little bit irresponsible, right?
Hugh, I'm so grateful for this. Now you've sort of opened up my world because we sold bonds right before that 50 basis point rate cut with the expectation that it would steepen the curve.
You were right.
And the reason, yes, but we were probably right for the wrong reasons, is what I'm now admitting and realizing. We thought, based on historical evidence, typically when the Fed eases late in the business cycle, but not in a recession, it typically has the impact of extending the business cycle. You typically get curve steepening or bear steepener out of that. And so, just based on the historical evidence, we were saying, hey, we believe in this resiliency of the economy. This is probably going to wind up in a bear steepening, or sort of in a weird steepening. You get the bull flattening on the short end. You're essentially painting the other side. I'm talking about the part of the iceberg that is above the water, and you're talking about the part of the iceberg that is below the water. It's the same result, but the part of the iceberg that's below the water is they're freaked out about the potential wave of refinancing, and if they don't do anything to get this 10-year up, we were going to start to melt that ice cube. Is that sort of a good summary?
That's it. And so and let's see if we can vibe with it further. So let's go back a little bit further. So 20, because the beginning of calendar year 2022 felt very, very comparable to the start of this year.
Yeah.
Comparable in the sense of complacent Federal Reserve and private market expectations for the shape or for the journey of short-term Fed policy rates. At the beginning of 2022, Fed's like, we're doing nothing. And the SOFR contracts like, they're doing nothing.
Yeah.
And what happened? We got 400 basis points of hikes, right? Yeah. That was one of the great trades. Like, so whenever the SOFR contracts are priced with like the pricing out 18 months, 2 years, nothing gonna happen. You want to be the other side saying, there's always something happening, baby.
Something's always happening.
And of course, we had that in January. We had this, and this is really odd. So the Fed, I'm like, yeah, you're acting irresponsibly. I know why you're doing it, and I get it, and I kind of applaud it, and I can make money from what your ambition is. But in January, when they came in with the remorse, and suddenly they don't want to be irresponsible, and they're like, oh we're done, we're back. Sorry about that, you know. And so the market took their words and said, well, we've now seen the low point in the rate cycle. Oh, yeah. And the next move will be higher, but for the next 18 months, we're going to be we'll plateau here, and then maybe we will go higher in due course. But the business cycle has been defined, kind of like how you were describing it. Yeah. That was odd, but let me give wisdom to them. So the 2022. So they hike. Okay, so back to either intended or unintended consequences of the Federal Reserve. So the Federal Reserve is pretty much meaningless until it's crazy, and it was crazy. You know, it's hiking rates 75 basis points. It did four 75 basis point hikes, right? Oh, yeah. Okay, and this is coming 1 year after this enormous refi activity. Okay, and so the banking sector has got a huge investment book in mortgages. Okay, and then you get this massive shift change in interest rates. Okay, and what that does is it destroys refi. Refi goes to zero. Okay, refi goes to zero. What happens to the duration of the mortgage book?
It gets longer.
Blows out. Oh, yeah. Now every day a bank is doing interest rate hedging, so it has an asset, and it has a nominal yield, but it has a lot of curvature, you know, things like duration, which are moving around, and it will use. I mean, it doesn't specifically, but let's assume they use like using financial futures 2 year, 5 year, 10 year, and they're either buyers or sellers of those contracts to take away the balance sheet movements impacting their balance sheet and causing them to record losses. Okay, so it's a crucial activity, and again, we're talking about hedging something which is 13 trillion. You're hedging half the U.S. economy, and hedging is noble and whatever, but it's tricky, it's hard, and then something totally unexpected has happened. The Fed just blown the system, boom, and rates. Okay, so what's happening is I'm Citigroup or JP Morgan, or I'm a US bank. I have to start shorting 10-year treasuries to manage to bring the duration of the two sides of my balance sheet together.
Yep.
Now, I'm shorting it at the same time as every hedge fund is going into the Eurodollar system and looking to borrow collateral to short treasuries because inflation apparently we're in the 1970s.
Yeah.
And then this is when it's truly ironic. Guess what else is happening? The Fed is not doing QE. QE would be very helpful in this environment. The Fed, rather than being a buyer of treasuries, it's not a seller, but it's not a buyer. You know, it's saying we're not going to reinvest the
QT is what I call it.
They're doing QT.
QT.
So it's like, so everyone in the system wants to be short treasury. And you get to the point in October 22, 23, thank you. And you get the 10-year, it hits 5. And I call that the Niederhofer rule of 5. The US economy presently as structured with financial leverage and the Eurodollar system and speculation, it cannot withstand nominal 10-year above 5%. Like this century, the number of days we've traded with a 5 handle, I think is measured in 7 weeks, if not less. The system can't tolerate. Why can't it tolerate it? Well, let me tell you. When we got there in October 23, we had lost Credit Suisse. And again, this is David Levison. We'd lost Credit Suisse, and the wholesale funding. Wholesale funding is when you do these rate hedges, and where you're sourcing your funding, you're trying to match it with the characteristics of your mortgage. Yeah. And that's hundreds of billions of dollars all the time being financed. And the wholesale market, there was a bit of a Citigroup. And we know that because if you take the market capitalization of Citigroup, the share price got down to high 20s or 32 or so. And there, if you represented its market cap as a percentage of its total balance sheet risk, I mean, it was you were measuring it in basis points. I think you were like 100 basis points, which is telling you the market's like, this could go. So you're getting funding risk. And this is speculation on my part, David's part, but most likely Jamie and Jane, they call Jay, the 3 J's. Jane, Jane, and Jane. And like, Jay, we got to talk. Like, Jane's got a problem, right? Like, and what is the problem? So you're free to persist in raising rates, but with this duration up my ass for my mortgage book, I have to short treasuries, and I can't. Everyone's got the same axe. I cannot lay the risk off, and Jane most likely will blow first, right? So just so you know, I can't tell you interest rates, but I can tell you the consequences. You're not helping, and you are going to blow the system. And from that moment, they pivoted with their language. There were no more 75. They hiked rates further, but they were 25, and it was moderation.
You just perfectly described our Jay wants a soft landing theme, which we authored right when that happened.
Well done.
Change in language was subtle, but it was incredibly impactful to markets.
Incredibly impactful.
100%.
So let's go to this year again. So first of all, the last remaining asymmetric trade is the reds on the SOFR. Like, you want to buy December this year, December next year, at the money. The expectation, we're still like, this what, like, if I'm right, and I'll tell you the reasoning for being right, Fed's going to be zero.
Really?
Policy rates are going to be zero within 18 months. This is the death of money. This is the death of money, right? This is the death of money. Scott Bessent et al. Are betting. So, like, they can't fire. It's always damn Jay, right? They can't fire Jay. I mean, Trump probably could do whatever he wants. They can't constitutionally, you can. But they can usurp the role of the Fed. And so they know. So And they want to be Vulcan, like, recession, we're still going to do it. We are going to do it. And eventually you're going to catch up and you're going to, but the bore is the Fed will cut rates, but it'll take too long to cut rates. Okay. It
100%.
should be cutting rates now,
I
but
agree. They should be doing
regardless,
QE right now, in my opinion.
and they should be, and the first thing I think they'll do is QE.
Yeah.
They should do QE. That would definitely help. That, but then, oh yeah, but think about it. So they should they, no, should, forgive me. Oh, should they do QE? Because let's talk about, okay, so let's see if we can do this slowly, right? Doge, Trump, tariffs, firing every federal employee, right? The Atlanta Fed is like -2.5 or something now casting on GDP,
Uh-huh.
and they keep doing more and more. The 10-year treasury, where's the 10-year treasury now? 4.42. Yeah, I mean, it's going to have a 3 handle on it soon. I think they're betting that they know about my iceberg, the one that's under the surface, and they're like, actually, we can get away with this. We can go very austere, very Volcker-like in our cutting the spending, because we can get that. If we can get 10-year below 2, we will, to our constituency, our hard-pressed households, we're going to lower their mortgage to the floor, and they're going to love it. They're going to like, wow, you're firing these people, but government's got to be destroyed, but you're making us feel wealthier and richer. So the game is, they're like, they want to bring the economy down because they know there's a reward in getting the 10-year below 2, it was such an enormous reward that Jay had to stop it in September. But there's
Yeah.
a new administration like, you ain't stopping it this time. We're cutting, and we're going to get the 10-year below. And then now, when the 10-year, if that duration then switches, and I'm Citigroup and Jane, and I'm managing my interest rate risk, I'm now a buyer of treasuries.
Oh, yeah.
It's very pro-cyclical. Now, imagine the Fed's going to come in, dope Fed's going to come in and do QE. What is QE? The Fed's going to be buying treasuries as well.
Oh, yeah.
And with today's inflation print, which comes close on the heels of last month's inflation print, they were both amazing. Hedge funds are going to be buying. Everyone now is chasing the tail. Yields are going to sink so fast, right?
Yeah.
And then the Fed's going to come in late. And because it's late, it's going to have to get rates. It's going to be cutting by 75 basis points.
100% to uninvert the curve. 100%.
So, I mean, and then finally, if, like, so for people, you watch this and like, that guy's crazy.
If anybody watches this and thinks you're crazy, they are crazy. This is fascinating stuff. You keep going.
If I could be bodacious and
by the way, I agree with everything you're saying, and our clients know that.
Yeah,
so either we're both crazy, or the people watching thinking you're crazy think I'm crazy too, and they're probably crazy. So keep going.
So I want to talk about wisdom. I want to talk about
please, yeah,
market wisdoms that I hold true with me from the body of my experience and my work, my observations. Yeah, I've been involved in markets for over 30 years.
That's my last question for every one of these interviews. Appreciate you.
And that is the most important metric in the financial universe today is, well, it's two things. So the anchor is, the question is, where was the S&P on the day being September 17, 2024, when the Federal Reserve cut rates by 50 basis points? Where was it? I'll tell you where it was. It was 5,700. Okay. And we're trying to, are we in a bull market, bear market? They came through with 2 further cuts, and the S&P, I think, at its wide, on the high wide, was 12% above that level. This week we crossed and we went below. Okay. I am hearing, like, in my world, in the hedge fund world, like, the huge guys. I mean, I can't. Can we mention
the unwinds have been vicious?
The guys who never make losses, and it's not the end of the year, but they've gone from good gains to really, really nasty losses on the year to date.
Oh yeah.
So there's a lot, but the Fed can't come in. The Fed can't come in yet. You need further asset destruction. But I mean, the names that I'm hearing, you're getting close. The names and the reputation is the reputation of LTCM. The indestructible are blowing up.
Oh
Okay.
yeah.
Uh, the Fed doesn't come in until you're like 5,000 or something, right?
Yeah.
So I think what happens, um, so the Fed's going to cut, right? And there's going to be a rally. There'll be a pretty decent rally. And the question is, does the rally, it could take us to the plimsoll line, the 5,700, maybe even 5,800, 5,850.
Yeah.
And then it'll slide again. And then you're going to reach a point where they're going to cut rates, and then the rally, you'll rally to a point below the 5,700. And at that point, this is nasty. This has the potential to be a 50, 60% S&P watershed down. And it's going to reveal itself. We're going to get rate cuts, and then we're going to look at where the S&P trades vis-a-vis the September 17. So we took the wide of 12, and we're now, I mean, where are we? I don't know if markets are up a bit today on the CPI print. We're probably around about the 5,700. So the signal is like, there's no signal. And we'll see. It's such a great market. I love this market just now.
Me too. I was saying to Colin, our production guy, this is the most fun I've ever had in my career. Just piecing the macro puzzle together. You got to tie in geopolitics, you got to tie in secular views, the cyclical views, the monetary views. You just did that about as good as anybody as I've had in a long time, and I'm glad I let you go because this was awesome. So,
Oh, that's cool.
where can
You
we
would,
send people to find you if they're sleeping under a very comfortable rock?
the well, I'm about to. I do a summer camp here in St. Barts, the Acid Summer Camp. I
You have to
do.
get down there.
I do, and maybe I'll invite you, Darius. It is just wonderful. We have a 3-day teach-in. We stay in this beautiful house. We have great fun. We have parties, but we learn. But it's the proximity. It's a real, like, you learn more lying by the pool with a cocktail. But
Amen.
we have a theater and we do that.
I got
But to find all that stuff, it's Hendry_Hugh Twitter, Hugh Hendry official on YouTube and Instagram, and my name again with Patreon and Substack. I'm out there publishing. But when you were saying that, it made me think of the 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 former Queen of Great Britain, Queen Elizabeth. She visited the city of London, I think, in 2009, and she was on the trading floor, and she said, "Excuse me, young man, could you tell me why did no one see this? Why did no one see this? Like, it's a good question. Why did no one see this? And like the joy and the fun you're talking about, trying to put the parts together. People don't see it, because they don't want us. You don't want to know that the party's going to end,
Yeah.
and then it ends because there's a lot of strange things going on, which they're not necessarily logical, and they're not being disseminated by the logical people. The Egyptian guy used to work at PIMCO who writes and he's on TV. These gray people in suits, like, you will not, if you buy a magazine devoted to photography, you're going to learn something about photography. If you buy a financial publication, you're not going to learn anything about finance.
Yeah.
So as wild and extreme as I am, I'm your provocateur, and I might just press a button that might allow you to work it out yourself in the future. So that's me.
Oh, yeah, that's exactly what you're doing with me. I got a bunch of research that I got to do. I've been writing down in my head the whole time, man. This is awesome. I hope to get an invite because I will definitely be there. That'll be
You're gonna
awesome.
go.
I look forward to it.
Cool.
Dude,
Thank
this
you
is
very much, my
amazing,
friend.
man. No, thank you, man. We'll definitely do this again in the future. You're awesome.